So this is the format of free cash flow to the firm. You start with profits after tax, right? Now, after the profit after tax, don't forget that this is free cash flow. It is based on cash flow, right? It is based on what? Cash flow. You add back non-what? Non-cash item. I would like class to give me some non-cash item that we are adding back.
Depreciation.
Okay.
Amortization.
Okay, good. Depreciation, right? Amortization. If there is impairment, right? Right. Now, these are non-cash items, class, right? So this is what you will have. Now, these non-cash items will already be deducted in the profit or loss account. But when you get to this free cash flow, what do? You add it back, right? You do what? You add it back. Now, targeting this, the next is increase in non-current assets. Increase / decrease in non-current assets. Class, when there is an increase in non-current assets, what will happen to our cash flow? Non-current assets.
Outflow. Decrease.
Class, when there is an increase in non-current assets, what will happen to our cash flow?
There'll
We
be a
have
decrease.
an outflow, so it decreases.
Yes, so it will be a decrease.
Okay. So when you purchase more assets over the years, it will be what? It will decrease your cash flow. Now, when there's an increase, right? Increase. So when there is what? A decrease, right? You add it back. In what? In non-current assets, right? Another thing is when you have increase / decrease in working capital. In what? In working capital, right? Working capital. So what is the formula for calculating working capital?
Current
And what is
assets
working
minus
capital?
current liability.
Okay. Now, you said current assets minus current liability, right? Now, are you telling me that part of what will form part of your current assets, there will be cash inclusive? Will you add cash to your current assets? Ahmed, Zainab.
Sir?
Now, this is one of the mistakes that we make sometimes. Your current assets, working capital, means what you use in running the business on day-to-day activities. Now, the current assets is excluding cash. The current assets exclude cash. Why? The current liability exclude short-term debt. Short-term debt has to do with financing items. They are financing items. They are not operational items, right? I repeat, working capital, what you use in running a business, right? The current assets there inventory, you say you can convert. Your inventory was the one that turned to cash. Is that not so? So, so now, the current assets will exclude cash. The current liability will exclude what? The short-term debt, because short-term debt is a financing items, right? It's a financing what item, not an operational items. It's a financing items. Please take notes. Now, class, when there is an increase in working capital, what will happen to your cash flow? What will happen to your cash flow? Class, increase in working capital, what will happen to cash flow? Right? Class, what will happen to your cash flow when there is an increase in working capital? Now, don't forget that you say your current asset. What make your current asset? Trade payable, trade receivable, right? Inventory. When you have more inventory in the stocks, right? When you have more inventory in the stocks, which means that you produce more raw materials, and by producing more raw materials, we actually decrease the cash of the company, right? Trade receivable. When people owe you, like you sell goods on credit, right? You sell goods on what? You sell goods on what? On credit. Is that not so? So now, when your working capital is increasing, what you use in running the business is increasing. So which means that cash is leaving out of the business. So increase in working capital, you subtract it from your cash flow, then decrease means that you are not buying, you are not producing more, right? Right? So that is decrease. It will reduce your what? Your decrease will not actually what? Reduce your what? Your cash flow, right? It will rather increase it, right? Because you are not buying anything, you are making the profit, and you are not. But however, Ahmed,
Sir,
okay, do you have any question? Sorry. So
uh,
please,
I was not.
okay.
Sorry, sir.
So,
Please, can you explain the working capital again? Sorry, sir.
we now working capital. What you use in running the business, that is working capital. Now, when there is an increase in working capital, it indicates, it shows that you are buying more raw materials to produce, to have more inventory, inventory, right? Receivable, right? So many people are owing you, you were not able to meet up, right, with your suppliers. So if there is an increase in working capital, right, what you use in running the business, you are buying this, you are buying that, is increasing, the cash flow will drop, right? Now, when you are not buying anything, the cash flow will remain the same. It will not actually drop, right? It will rather increase your what? Your cash flow. But class, some people argue that it is not actually good when you don't have increase in running working capital. Some people actually argue like that. But let's continue. When we when we get to another part, we'll still talk more on working capital. Current asset excluding cash, current liability excluding short-term debt. Short-term debt is a financing item, right? It's not an operational item, right? It's a financing item. So therefore, you remove it. So another thing you should look at is there is replacement cost. Maybe you replace an asset, but everything is still going to fall under non-current asset. So there's no need of me bringing replacement. Maybe there's an increase in replacement cost of assets. It will reduce your cash flow. When there is a decrease, it will not actually increase your cash flow, reduce your cash flow actually, right? It will not what? Decrease your cash flow. So it's still the same thing as non-current asset, because what are you replacing? You are replacing your asset. Now, this is all what you need to do. Please, class, in every question, whether ACCA or at ICANN level, profit after tax may not be given in a question. You may be the one to determine the profit after tax. You know how to determine profit after tax. Depends on the industry. Maybe is a manufacturing company, you will have your revenue, the cost of sales, the gross profit. You will have your EBIT, which is earning before interest tax. When you have your interest, you have EBIT, earning before tax, right? When you have tax, you have your net income. Is that not so? So you may need to start something like that in some questions, right? So get prepared. Then after this, you have free cash flow. You are now arrive at free cash flow to the firm. This is all what you need to do, class. This is all what you need to know in working capital. Don't forget that your working capital is your current asset minus your current liability, right? Then when you minus it, you now check. Let's say, let me give you an instance. Okay, let me complete this. This is free cash flow to the firm. This is what? Free cash flow to the firm, right? This is what? Free cash flow to the firm. Let's say this is free cash flow to the firm. I'll give an instance of working capital so that we'll get that, class. Now, don't forget that your free cash flow, you may be estimating for 2027. They may tell you that you should start from the beginning. You have to build your profit after tax from the beginning by saying that the current sales of 2024 is 20 naira. Assuming that the sales will increase by 2% in 2020 what? In 2025. You can see, which means that you have to do free cash flow 2025. They will not tell you that the free cash flow is, let's say the free cash flow is for 3 years and you are in 2024. You will start 2025, 2026, and 2027. Don't forget that Ahmed want to buy over Mary Limited. Ahmed now want to know what will be his fate at the end of the 3 years. Now, don't forget that when Ahmed get this, maybe for the first year, Ahmed is going to discount this free cash flow to the firm. To what? To the present value. Because Ahmed want to know the present value of that cash flow. So please use weighted average cost of capital to discount. You use what? Weighted average cost of capital for the DCF. So when you are to discount, you use what? Weighted average cost of capital. Is that not so? So, because why do you have to use weighted average, class? Because this is free cash flow to the firm. You want to determine what will be available to the what? To the firm. Right? Class, before I continue, do you have question?
So for free cash flow to equity holders.
No, this is free cash flow to the firm first. I started from the
Yes,
firm, so we are
I want
still going
to
to
ask a
equity.
question. I mean, for
So, okay, in free cash flow to equity,
yes, what discounting factor would they use? Is it cost of equity?
we'll get there. Is cost of equity.
Like this free cash flow to the firm, they are using WACC.
Mm.
For equity holder, would they use cost of equity or would they
Yeah,
use WACC?
no, you use cost of equity because you are talking about equity. not to the firm. What will be available to the equity holder?
Okay,
Do
sir.
you get?
Yes, sir.
Yeah. Yeah. Class, are we still together? Who is against me in this class? Olamide. Olamide is just joining us today, I guess. Ayomide, she's just joining us today. And Zainab, I think Zainab she has been consistent. Okay, Taiwo too she has actually been consistent. Okay, Ayomide,
Sir?
okay, do you have question? I want you to ask question so far.
No, sir, I don't.
Okay, good.
Thank you, sir.
Olamide, yeah, good. Olamide, are you still there? Okay, let's continue, please. Okay, this is free cash flow to the firm. Now, what is free cash flow to equity, class? Free cash flow to equity. Now, don't forget, I mentioned something. I say I want to show you something on working capital. Let's say you are preparing free cash flow for 3 years. Let's say this is current assets. Year 1, let's say year 1, year 2, and year 3. Right? Year 1, year 2, year 3. So there is current liability, right? Current liability. This is liability here, right? Now, if this is in the first year, this is like 20, this is like 30, this is like 40 naira, and this is like 10, right? This is like 20, and this is like 10. Now, what is the changes? What is the working capital? The changes here. What is the changes? Now, the change in working capital, right? The change in working capital, WC, will be what? The difference between the current asset minus current liability, right? So what is the difference? This is 10, right, class? And this is what? 10. And this is what? This is 30, right? This is 30. This is the change. Now, don't forget that you want to know if there is an increase or decrease in what? In working capital. Let's say this is 5, actually. For the purpose of this class, let's say this is 25. So you want to know if there is an increase or decrease in working capital. Don't forget that year 1 will be 0 because it is usually the last year. You can see when you are given the last year, let's say you are preparing free cash flow for 3 years. You are in 2024, right? You prepare for 2025, 2026, and 2027. Is that not so? Now, the 2024 that we are now, you minus it, right? You minus it from 2025, which is this. So now, for the purpose of this class, now you have just 3 years. Now, if you want to know if there is an increase, class, sorry, this is working capital. Sorry. Okay. Okay. So this is working capital, right? Now, the changes means the difference, changes in working capital. Now, this will be 0. Now, the difference between year 1 and year 2, look at it very well. You can see that there is the increase, right?
Yes,
Class,
sir.
class, you see that there is increase. Is that not so?
Yes, sir.
Increase of 5 naira. You bracket it. there is what? Increase. It will reduce your cash flow.
Sorry, is it year one or year two?
So is it 5 naira or 15?
It's not 5, it's 15.
Okay, is what? 15. Is that
15,
also?
yes. Yes.
Okay, thank you.
It's the next
So
one of
this will be
5.
what?
5.
There is an increase of what? This is 5. Is that also?
Yes, sir.
So this two. So this is a decrease in what? In working an increase in working capital. Sorry, this is an what? An increase in what? In working capital. You can see that from 10 to 25, from 25 to what? 30. Some people argue that is actually good, actually, but we'll get there when we start question. So this is how it works, right? This is how it works. Now, free cash flow to equity,
So I want
right?
to ask a question.
Okay.
So the changes, I'm thinking, I don't know, maybe it is how it is. Is this supposed to be for year one, 10 minus 0? For year two, 25 minus 10. For year three, 30 minus 25.
We assume that actually. Hmm? We assume that we don't have figure in year 0. 0 minus 10 is what? That is minus 10, right? Is that not so?
Yes, sir. And my question is it supposed to be 0 minus 10 or 10 minus 0?
No, it's 0 now. It's from year 0. You don't have anything there. It's from year 0, right? We assume that it is from year 0. Now, don't forget that if, for instance, let me give you a practical illustration so that you not confuse yourself. Now, you are in 2024. The figure for 2024 is, let's say, is 20 for 2024. And you are estimating free cash flow for 2025, 2026, and 2027. Now, if the figure, because you need to include the current assets for 2024 year, class. You need to include the current liability for 2024 year, class. So at the end of the day, your working capital that you get, because you are estimating for 2025, 2026, and 2027, the working capital that you arrive at is this. Now, you can now say 20 minus 10 is what? 20 minus 10 is what? That is 10. Is that not so?
Yes, sir.
What happened to the working capital? There's a decrease in working capital. You add it. So I hope I've answered your question.
Yes, sir.
Now, what is free cash flow to equity? Is the cash flow available to the equity holder? Oh, the class will end in 13 minutes. Wow. Okay. In 13 minutes. Okay. No problem. So, what is free cash? Okay. So, excuse me. So the free cash flow to, please, Ahmed. So when it is 5 minutes, let me know. This is 12 minutes already. So that we can end the call and create another link, please.
Okay, sir.
Now, the free cash flow to equity is the cash flow available to who? To the equity holder after deduction of operational expenses, including tax, investment in working capital, and investment in non-current assets. So what it means is that when you deduct the operational expenses, the tax that the company paid, the working capital, and the non-current assets, what you have left is free cash flow to the what? To equity. Class, I'll give you the format. The only difference between the free cash flow to the firm and to equity is I omitted something here and nobody mentioned it to me. Interest. Interest is a non-cash item. Interest net is a what? Is a non-cash item. Right? It's a non-cash item. Don't forget that if the interest in the profit or loss account, right? If the interest in profit or loss account is 20 naira, don't forget that there will be a tax relief for the firm if you are to pay interest of 20 naira. There will be a tax relief. Don't forget, under the cost of equity, under the cost of debt, you have a tax relief when you are to calculate, for instance, the cost of debenture. Is that not so? Interest open bracket 1 minus tax rate divided by what? Market value or market price what? As interest. Is that not so? Market price as what? As interest. So now there will be a tax relief. That is why it is called net. So you say 1 minus tax rate. 1 minus what? 1 minus tax rate. 1 minus what? Tax rate. So that is the net I'm talking about here. So don't get confused when you see interest net. The figure in the profit or loss, then 1 minus what? Tax rate. Now, the only difference is that, don't forget, this is free cash flow to the firm. Now, the only difference is that, you are talking about equity holder. You don't talk about, when you talk about equity holder, you don't talk about interest, because equity holder are not collecting interest. They are expecting dividend, right? Or an equity holder can go for dividend or capital appreciation. So one of the difference is that there is no interest in free cash flow to equity. There is no what? No interest, because you are talking about equity holder. Now, another thing that makes it different is increase. Let me copy this. Increase / decrease in borrowing, in total borrowing. When I say total borrowing, it includes their current liability and non-current liability class. So when is there an increase in borrowing? Now let me ask you this question, class. When there is an increase in borrowing, what will happen to the cash flow? And when there is a decrease in borrowing, what will happen to the cash flow? Class. I'm listening. Hello? It seems I'm the only one on this call. Hello?
Listen.
When there
Yes,
is
sir.
an increase in borrowing,
There will be
is
more
it going
cash
to
flow.
increase?
It's going to increase the cash flow.
Oh, it will increase the cash flow. Thank you so much for that. Who mentioned that?
Yes.
Okay, Mary. Okay, good. So you collect money from Mr. A to add to your business. It is going to increase your cash inflow, right? So decrease in total borrowing will reduce your cash flow. So when you subtract and add, you have free cash flow to equity. Class, is it up to 5 minutes?
So it's about time.
Oh, it's about time. Okay. Let me create another one. Okay, let's switch. We can switch, right? Free cash flow to equity. You use what? Cost of what? Cost of equity. Cost of equity as the DCF. So when you are to discount it to the present value, you use what? You use the cost of equity. So the cost of equity that is being given, or you calculate it using CAPM and some other stuff. So I think, do you have any question? Any question? You can see the difference between the free cash flow to equity and free cash flow to the firm. This does not consider interest because it is for equity holder. Borrowing, increased like decrease in total borrowing includes the current liability and the current and the non-current liability class. So whichever question I can want to set on free cash flow, if you picture this and you understand that, okay, this is what you need to do, class, you are good to go.
The adjustment are the issues.
What are the adjustments?
Those additional information.